Uncover secrets to health insurance plans. The American Journal of Public Health in 2019 found that 66.5% of bankruptcies in the US were from medical expenses. Want to know how to save thousands of dollars on your health insurance? Knowing the terminology of health insurance is key, and will help you uncover the secrets with this terminology so you can use it to your advantage. The more educated the consumer is, the more effective your health insurance plan will be. Everyone is in need of quality health insurance. Most people will obtain it either through their place of work or through the government in the form of free socializing healthcare called Medicaid, or for seniors, Medicare, which is not free but still socialized health insurance. The rest of us have to obtain our private health insurance from either the marketplace, oftentimes called Obamacare. By law, it's called the Patent Protection and Affordable Care Act, or ACA, or from non-government sponsored health insurance like short-term plans, hospital fixed benefits, or various supplemental plans. So, there are other options you may qualify for. You just were not made aware of those options. Talk to a licensed health insurance strategist or mentor for help. Keep watching and listening, and you'll learn how to keep out of trouble. Please like, comment, share, and subscribe. Hit the bell below. Let's continue. If you obtain your insurance from a group company plan, you may or may not have a variety of plans to choose from. If you elect to take the coverage the companies provide, they may pay a portion of your plan, or they may not. Employers with 49 employees or less, by law, do not have to provide any type of health insurance or benefits. So if you're in a company that size and they provide you with health insurance, thank your boss or the owner because they do not have to provide anything. Companies with 50 or more full-time employees have to provide health insurance coverage. So you're offered a health insurance plan. What types of networks are there? There are 4 different types of network flavors that may be offered: PPO, Preferred Provider Organization, HMO, Health Maintenance Organization, POS, Point of Service, and EPO, Exclusive Provider Organization plans are all types of managed healthcare plans. What is a PPO? A PPO is a type of health insurance plan that provides coverage for medical services from a network of providers who have agreed to offer services at discounted rates. Members of a PPO typically have more flexibility in choosing their healthcare providers, and they don't need a referral to see a specialist. PPOs usually require members to pay a copay or deductible for each visit, and they also usually charge higher premiums than other types of insurance plans, such as HMOs, health maintenance organizations. However, members of a PPO have access to a wider network of providers and usually have more control over their healthcare choices. PPOs are a popular choice for individuals and families who want more control over their healthcare choices, and who are willing to pay a higher premium in exchange for more flexibility and options. What is an HMO? An HMO, or Health Maintenance Organization, is a type of health insurance plan that provides comprehensive medical services for a fixed monthly fee. HMOs typically require their members to choose a primary care physician, PCP, who acts as the gatekeeper for other medical services. HMOs often have a limited network of healthcare providers that members must use in order to receive coverage, and they may require prior authorization for certain medical procedures. HMOs are often known for emphasizing preventative care and keeping costs low by negotiating with healthcare providers and limiting unnecessary procedures. So basically, if you want to see a specialist, you need to get a note from your mother. What is a POS? A POS in health insurance stands for a point of service plan. It is a type of health insurance plan that allows members to choose medical services and doctors from a specific network of providers within the plan. Under the POS plan, members can opt to receive care from providers outside the network, but they will have to pay more out-of-pocket costs. The POS plan gives members more flexibility and freedom to choose their healthcare providers than an HMO, but less flexibility than a PPO. What is an EPO? An EPO, Exclusive Provider Organization, is a type of health insurance plan where the insurer has contacts with a specific network of healthcare providers. These providers agree to offer medical services to patients at a discounted rate negotiated by the insurer. If a patient seeks medical care outside of this network, they may not be covered under the EPO plan, or may only receive partial coverage. EPO plans generally have lower out-of-pocket costs than other plans, but they also offer less flexibility in terms of provider choice. EPO plans typically require patients to choose a primary care physician to coordinate their care and referrals to specialists within the network. I hope that wasn't too confusing. You can always rewind and listen until you understand the networks. Now, onto the confusing world of terminology. But before we do, if you haven't yet, please like, comment, share, and subscribe, and hit the bell below. Let's continue. Now, let's talk about terminology within these health insurance plans. What is a copay? A copay, short for copayment, is a fixed amount of money that a patient pays out of pocket for a healthcare service or prescription drug at the time of service or purchase. Copays are often set by the health insurance provider and are intended to share the cost of healthcare services between the patient and the insurer. Copays can vary depending on the plan and the service provided. What is a deductible? A deductible is an amount that an individual or a family must pay out of their own pocket before their insurance coverage begins paying for their medical expenses. For example, if a health insurance policy has a $1,000 deductible and an individual incurs $5,000 in medical bills, they must pay the initial $1,000 themselves before the insurance coverage begins paying for the remaining $4,000. Deductibles can vary in amount depending on the policy and the insurance company. The 2023 ACA Marketplace or Obamacare plan deductibles were $9,550 if the plan was not subsidized. That is a lot of money most of us cannot afford. Remember me talking about bankruptcies in the US? Here's one spot you can get hurt. What is a co-insurance? Co-insurance is a term used in insurance to debate the sharing of costs between the insurance company and the placeholder. It requires the policyholder to bear a certain percentage of the cost of the claim, while the insurance company pays the remaining percentage. For example, if the co-insurance is set at 80% and the claim amount is $1,000, the insurance company would pay $800 and the policyholder would be responsible for the remaining $200. Co-insurance is often used in health insurance policies and property insurance policies. What is a max out-of-pocket? A maximum out-of-pocket, or MOOP, refers to the total amount of money that an individual or family is responsible for paying for covered healthcare services in a given plan year. Once this amount is reached, the insurance company will typically pay for all covered healthcare costs for the remainder of the plan year. The MOOP may vary depending on the specific healthcare plan chosen, but it is typically a high amount designed to protect individuals and families from catastrophic healthcare costs. Here is another big area where bankruptcies can take place. What is a pre-existing condition? A pre-existing condition is a healthcare condition or illness that a person has before applying for or enrolling in a health insurance plan. Examples of pre-existing conditions include chronic diseases like diabetes, heart disease, and asthma, as well as past injuries or surgeries. These conditions affect the costs and availability of health insurance coverage. However, under the Affordable Care Act in the United States, insurance companies are required to cover pre-existing conditions. What does the term usual and customary refer to? The term usual and customary refers to the amount of money that healthcare providers in a particular geographic area typically charge for a given medical service or procedure. Insurance companies use usual and customary rates as a basis for determining the amount of reimbursement they'll provide to a particular medical service or procedure. In other words, if a healthcare provider charges more than the usual and customary rate for a particular service, the insurance company only reimburses the patient up to the amount considered usual and customary. What does the term prior authorization mean? The term prior authorization refers to the process that a healthcare provider must follow to obtain approval from an insurance company or healthcare plan before providing certain medical services or treatments to a patient. Insurance companies may require prior authorization for certain procedures, medications, or other medical services that are considered expensive or that have a high risk of overuse. This is done to control costs and to ensure that the treatment is medically necessary. To obtain prior authorization, the healthcare provider will typically submit a request to the insurance company or healthcare plan, which will review the requests and make a determination based on specific criteria. The criteria may include factors such as the patient's medical history, the severity of the condition, and whether alternative treatments have been tried. If the prior authorization request is approved, the insurance company or healthcare plan will typically provide the provider with an authorization number or code that can be used to bill for the service. If the request is denied, the provider may appeal the decision or work with the patient to explore alternative treatment options. Here are the parts that really stink. First, patients will be responsible for any cost associated with a service that is not covered or authorized by their insurance plan. So it's important to check with the insurer before receiving any medical services. Second, most insurance carriers or healthcare plans are not using licensed medical doctors in approving or disapproving these authorizations. Pre-existing conditions and prior authorization issues are one of the biggest bankruptcy generators in this country. You may need the treatment for an issue, but you'll have to finance it yourself because the carriers can't. This is why you need to understand the terminology of health insurance and read the fine print on your policy. Then, be strategic on how you cover yourself and your family. 2 important facts you should know. The first fact is, health insurance carriers are in business to collect premiums, not pay claims. They're in the business of making a profit, but under very strict rules. The second fact, 75% to 80% of individual retirement funds, IRA, 401ks, and other retirement funds hold health insurance companies as investments on your behalf, so you want them to make a profit. In our next video, we'll explain in detail all the different types of coverage and how you can strategically incorporate them into your plan.